We're having to pay the piper for a lot of sins, Elijah, and it seems that he's coming with his hat and his spear to make sure we stump up real deep this January. And that's why I want to put everyone on alert.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today for this end of the year wrap up on December 31st, 2024 is our good friend Francis Hunt from the Market Sniper. Francis, thank you so much for joining us today.
Delighted to be with you. Thanks for having me on again, Elijah.
Well, it's great to have you today. We wanted to get a end of the year wrap with you and kind of look back at 2024, what you're expecting in 2025. We're talking off air how it seems like all the triggers for really a major reset have really been triggered. So if you could get into that, and it seems to be interesting timing as we're, heading into the inauguration for the new president.
Yes, Elijah. Again, thank you for having me on. Delighted to be with you and your audience again, and would like to wish them a Merry Christmas and a safe and prosperous New Year. Having said prosperous, I do need to maybe add a degree of defense might be the best form of attack in this environment. In our recent update on our newsletter that we do, we highlighted for us that a number of key technical. So essentially, when you're talking to me, I suppose the one thing I do that might be different, and you had an amazing show, by the way, with Bill Holter, Andy, and Alistair, by the way, great stuff, and everyone should watch that. But the one thing I do that is different from everybody else is I'm very chart-driven. Can we get an insight before the news of something that's happening? And here's technically 3, 4, maybe 5 things that are concerning me that technically have occurred that point to a dollar surge in valuation, not the healthy, our economy is awesome surge. I'm talking about the sugar rush schizo surge in strength that I'm expecting on the dollar. And it's going to be rates driven potentially. I've spoken about this one. So let's start with number one. What are these 5 things I'm warning about that have happened technically, Elijah? And the 10-year is one of them. The 10-year yield on debt. So what I'm going to do is jump to sharing and get that image straight up with you. And let's just see if we can do that. So what I brought up here for you, Elijah, and for your viewers is the US 10-year. We probably mentioned this before, that rates are likely to go higher for longer and the pullbacks be shorter and less deep. And what we've actually has happened over the last 4 months. Since September to December, in essence, we've had 100 basis points, and Zero Hedge even did an article, which impresses me, in cuts delivered by the Federal Reserve. And we actually had, at the same time, 100 basis points climb in the US 10-year. So this is a complete divergence. That's a 200 basis point swing. That's 2%. In short, what you're getting is what the Fed is doing is not actively affecting the market. That's my interpretation to a degree. Some will say, well, they sounded hawkish about their cuts, and so the market's reacting to the hawkishness. No, in effect, they've delivered a full basis point in cuts. They did a half, they've done 225s, and now during that time frame, you've actually climbed substantially from around 3.5 right the way up to 4.5. we've had just a small pullback. We thought we'd come back a little bit more in this. It's even surprised us. This red circled area that I'm just pointing to right here, what you've actually had is a breakout of this falling wedge. So we've always said to you, the red line is the one that fails, but we felt that this was going to be mid-year next year, a little bit more can kicked down the road. And so we've always been monitoring this because it's been one of the drivers of the recent dollar strength. The fact that it is better to have dollars because you're getting paid more interest rate. In short, the collapsing of the debt markets. Remember that relationship. The collapsing of the valuation of debt markets, which is pushing up the yield, is in essence a driver in a perverse way of dollar strength, whilst you are getting huge devaluation on the asset that is the debt instrument. So you tend to left, right when you devalue. You devalue debt and you sometimes even get relative currency strength, and then the debt holds its level for a while, and then you get the currency weakness. And so they do this cha-cha-cha together. And at the moment, it's being the debt-driven weakness driven by yields. That has given dollar an unhealthy strength. Let's refer to that. It's not global economy is great or US economy is great. This is a schizophrenic strength. And this breakout on the 10-year is quite significant because we've called again for the 5% to fall. And what's actually happening is I think on the home markets now, you guys are looking at fixed rate deals for the average man in and around 7%. For a 30-year fix, maybe a 25-year fix will come in a bit under, maybe a great credit score you'll get a bit under. But the point of the matter is that's going to affect real estate. It's going to affect assets as a whole. And listening to Alistair yesterday with your other guests, initially the market can go up on that early tightening on the basis that we're tightening the dollar strong. Well, we've had cuts recently. I think the next move is going to be the beginning of tightening, and then eventually things are going to start breaking. A lot of corporations borrowed to pay dividends because it was cheaper. It was cheaper to do, and hence they built up a lot of cheap debt. And now as these interest rates get more expensive and the market is almost taking the pricing away from the Fed, that is part and parcel of that 2020 call we made of debt-based collapse. And that is seen in assets which are basically the inverse of this chart. But if you'll allow me, I'll pull up the TLT and show you that this is in effect a long-term debt ETF. And it has done nothing but fall since 2020. So let's get a big enough chart for you to see. You were up at 180 and you've just broken down out of this rising wedge in the same way that the yields have broken up against a falling wedge. So you can see that natural inversion between valuations and interest rate. So that's point number one. You are seeing chronic debt devaluation. If it gets further disorderly and the triggering event of that falling wedge break that I showed you in the initial chart is a potential warning, you are seeing debt-based collapse. And it's leading to schizophrenic dollar strength for now. That's a technical shoe to drop number one. I'd just like to hand the talking stick back to you because you may want to come back at me before I go into the next ones.
And I guess just pointing this out, as you mentioned, how interest rates are rising, but the Federal Reserve right now is easing, right? They're cutting interest rates, but you actually think that the Fed will catch up and start tightening again?
I do think they will be forced to, Elijah. So in essence, that's why it was quite a hawkish cut that they gave recently. And that's part and parcel because of the devaluation of the asset. So the Fed is caught between, we let some steam out of this debt market's valuations and we let it sell off badly. The response, what it does is it keeps a lid on inflation because you're getting this dollar appreciation. So all your imports are relatively cheap. So it'll keep a slight lid on inflation, although inflation is showing its head and will resume in our overall opinion. So it makes the inflation a little bit more everybody else's problem that's not in dollars for a while. But eventually, if you get a one-way bet on the downside of the debt markets, it could turn into contagion. And then you get an asset-based collapse there. And that's a very, very negative thing. It's also, I think, one of the reasons why so much money is flooded into the equity markets. And you have people like Daniela DiMartino Booth and other analysts saying, you're in the top 2% of hypervaluations of all time. You know, you only spend that amount of time at these extreme valuations in terms of PEs, CAPEs, various other GDP sort of market cap to sales type valuations in the stock market. So what you actually have is a deflating debt bubble in terms of the asset valuations that's pushing rates. It's causing a bit of a dollar bubble, and at the same time, it's crowding a lot of capital into the equity markets. And more of that money should, in fact, be going to gold. But initially, because of that dollar strength and people trained to be kind of a little bit not on gold, don't forget there's interest rates going up on the 10-year, will potentially point to better yields coming. So people will rather hold dollars and earn yield than hold gold for now. Until such time as the contagion becomes disorderly, then everyone goes capital preservation. And then instead of all that bond money going into the overpriced equity market, we may see a bigger slice ending up in the precious metals. But we have to go through this process. And right now, I think it's a bit of an ordinary spell short term for the precious metals, which is one of the things everybody's going to want to know. Francis, what's your take for gold and silver? We could go a bit deeper in that in due course.
But I guess first, if we could maybe look at the other triggers you mentioned that are really signaling that some sort of reset or collapse is coming soon.
100%. So I would like to give you trigger number 2. I showed you the yield initially. This is staying in. I'm going to cover the 2 debt indicators because they very, very specifically around debt and interest rates. So while we're talking about that, we may as well do this. So this is the 10-year minus the 2-year. So it's long minus short. This is typical yield curve inversion discussion. And you often get to the point of your contagion collapse when you are reverting back positive strongly. That is usually when you get the name and the collapse. So it's not on the inversion, which is the price behavior below the blue line. So I'll just highlight that and choose nice fat Cokie so everyone can see it. The period below the line is warning that something's coming. This period over here. And I'll also highlight that this was one of the deepest and longest in the modern era since the 80s, the post, the Volcker era of peak rates that gave us the 40-year bond bull market and let it be put forward as a reserve asset. Our argument is it's no longer a reserve asset. It's going to lose too much capital. It's not going to preserve capital, even though rates will spike. The yield won't compensate you. So with this large reverting back now positive, and the inversion having been so big and for so long, we're expecting a big crisis at the end of this due to the nature of charts. And of course, we also know the debt situation is at one of its most extreme. So what's technically happened here is we've reverted positive roughly over there. As you can see, we went up and we did typically what we always do. After going up, you get a pullback to the key level, the 0 mark. And now we are moving very strongly positive. So this is going up even more steeply than the 10-year. At the moment, the 10-year is actually having a little bit of a rest and coming back, which is why Bitcoin is kind of rallying. Gold is not going down too much. Some of the risk on type assets are holding their own for now. They're not in any major drama sell-offs. But this strong reversion is usually when you start to get the name for your crisis. So if I just go back out, we're on a weekly time frame. If I just show you the modern history of yield curve inversions and take you from this chart back, you'll see the early 90s slump. It's only when you start to get strongly steepening here that you tend to get the named crisis. That was the sort of savings and loans crisis. This was the dot-com. You did also have a small Asian crisis in there. It wasn't small, but the inversion was kind of small. Of course, you had subprime. You were inverted on subprime from around 2006 through to mid-2007. But your key moment of Lehman's came in 2008. We also had a minor inversion just before the CV19 events. But that was in and around 2019, around mid-year. But the key event came as you were turning 2020, end of 19 into 2020. So you can see there's that small delay. And the thing that I want to point out is this reversion is very brisk. It's moving fast, more so than in other inversions. It's really coming back. You can see subprime was pretty steep, and .com was pretty steep. But some of the others, you had walkouts moments. This is really, really powerful. Since we revisited, this is for the month under review, just nonstop up. And we have a target of 0.75 there, which is going to highlight the difference, almost 3 basis points, 325s beyond. So this is a strong steepening suddenly of the far out curve. So that's the second one. It is similar to the first one, but it is giving a different signal, and it's more about the differential between two long-term and short-term debts. The acceleration on the reversion positive is when the crisis comes, and we are there right now.
Now, we've already seen a little bit of a pullback here in the last few weeks for the stock market. If we do see this crisis unfold, where do you think precious metals could go in the short term?
Yes, let's show you the gold, and then I'll roll into, if that's okay with you, the third indicator, because they go hand in hand. I'm a tiny bit concerned about the price action here. We are in this channel. So you will recall us, we were with you actually when we said this little setup is going to be a golden moment to be even leverage long. We don't purport everyone should utilize leverage without understanding the risk, but we were, and this was a very nice, in short duration move before we went into a little bit of containing and squeezed higher up to here. We still have the targets, by the way, that we've given you, which are just sub the 3,000 awaiting us. But there could be a little bit of a detour. I'm not mad for this grinding structure under here. And there could be a test for us below this larger channel. We might get a little bit of a breakdown out of this channel. And I'm going to roll into the gold-silver ratio as to why I think it's going to be a sideways poor and maybe downside environment for precious metals short term. So as I say, this doesn't change our macro bull bias, but there's times when we are, saying get leveraged and really enjoy the ride, like over here. And there's times where I say I wouldn't be leveraged long at this point in time, and that would be right now. The gold-silver ratio is our triggering event number 3. So a little bit of concern about gold's place, and probably maybe even more concern with the gold-silver ratio. This is one we brought up on your channel many times as well, and this did a triggering event as well. And we've said, once this sell-off here never followed through, you may recall, we thought there's a real chance, and we had a silver surge during this period that got us into the 30s and out of the 20s. And we even broke 75, a key level, but we couldn't hold it. We came back up, and then we really bounced back hard. So in the end, we never got away. It was a bit of a fake out break. And then we said that's a problem and a concern. It points to this overall gold-silver ratio more likely treating this structure as a continuation structure with a break to the upside. So we're unfortunately kicking the can down for those patient silver investors, and even giving some dull to disappointing news to gold holders in terms of price performance short term. So it will be a great period to buy dips, and the dips may indeed be coming for the true and faithful and the patient. And this triggered here, and that points to gold-silver ratio going higher. And that's normally associated with a risk-off type vibe, dollar dominance, and we'll be coming back to that. We've already spoken about the rates hike, disproportionately high rates in the US due to collapsing valuations on debt. Not a healthy dollar strength, but the schizo dollar strength. And I think this is going to work exactly against gold and silver. And we're seeing this in the gold-silver ratio as the ratio is stretching again and may even get back into triple figures, but looks like it's going to take a walk into the deeper 90s at the moment. And that is our third reason why we're expecting some potential crisis to occur that's going to lead to that very, very dominant gold, about that dollar, very dominant dollar strength, which is going to be a headwind for gold and silver.
Now, as we talked before the interview, the interesting thing is the timing of all of this. Trump just got elected and he's about to be inaugurated. Do you see any connection there?
I do actually. I want to show you somebody else's tweet that's been going on, especially if you want to we bring in the inauguration of Trump. I mentioned to you just before we started, they've typically liked economic collapses on the center-right party, even though both parties contribute to that eventuality. And we've seen a lot of those kind of events occur. In fact, the events of CV19 was on Trump's watch and was a major economic maelstrom. So I'll read this to you. In 2025, you have $7 trillion of debt that needs to be refinanced. That's over and above the fact that you're typically spending near double of your tax take. That means your tax take, and again, you've got to raise new, fresh debt for that over expenditure. Milton Keynes will tell you government expenditure is in fact your inflation. Your government in the US is hyper spending. They spend more than they get in income, almost twice. And that all has to be rolled into debt instruments, which means a glut of debt instruments. And now, because of Yellen's tendency to put it on short-term debt because the rates were lower on the short-term debt. So typically in a normal yield curve, the further out you go, the more you pay. More risk, more compounding. You might default, you might disappear, etc. So rates of borrowing go up the longer you do it. And in this environment, she put it all out short to keep the interest payment low on the Democrats' period. But a lot of that maturing rollover debt is now, as a poison pill, in essence, showing up in 2025. I'd also like to point out the concerning tendency for Elon Musk and now Donald Trump himself to talk about the debt markets and associated with bankruptcy and other versions. There's a lot of preceding mentally people for some form of a debt crisis, as if they're almost pre-preparing people for that. $7 trillion to roll before you spent a penny for that year. A lot of that expenditure already pre-committed through long-term contracts and everything. That's going to be a lot coming down the chute in the bond markets, and hence why I say they need to further devalue that people are going to demand higher interest to be buyers of that. There's a reduced appetite for it. I would imagine a lot more buying from Belgium and Cayman Islands and possible other proxies that could be deemed to be under the control of the US could be occurring. I don't expect China. I certainly don't expect Russia to be in the bidding market for that. And I'll add throw another spanner up in the air. People can make of it what it will. But this funny narrative of China being blamed for hacking the treasury market. There's nothing to be gained. China have a buying system that plumbs them straight into the treasury market. They were big buyers. There's nothing to be gained to be hacking that. There's nothing worth stealing as far as I'm concerned. So a lot of funny narratives in and around the functioning of the debt narrative, the debt markets, plus, as I say, the X activity. All of these things smell a lot of preparation for a bit of a psyop on the debt side. And it's well overdue. The fact that they've managed to take this lot together throughout the Democrats' period, there could be a hot landing for Trump in terms of inauguration straight into the debt markets in terms of my view.
What is your perspective on, I guess, as we look into 2025 with the potential for this crisis, how should people be reacting to this? What are some of the best ways to prepare?
I'm actually looking at the dollar strength as one of the hedging mechanisms for gold underperformance, silver underperformance. People that are in crypto are going to potentially have, being a high beta asset, could suddenly have underperformance there of some scale. Of course, you know what Trump said also in the crypto space. They're very keen to establish digital gold, Bitcoin as that, because it feels like an on-ramp away from the precious metals. They want this digital existence for everybody, which actually makes you totally dependent on state control systems, Wi-Fi, internet. There's lots of things about who gets to use the internet, digital IDs, and lots of other things that are quite draconian and I wouldn't describe as libertarian coming down that chute. So physical gold is a nuisance for them. And of course, Trump even referring to being a buyer of potentially Bitcoin for the country as a whole would just be further backstop to the likes of Michael Saylor as putting in a bid in there. But if the dollar surges and everyone panics, price discovery still takes its place and those things can sell off. If I can bring you to probably one of the last signals, I would say dollar strength on an unhealthy surge is potential, potentially on the cards. And the chart I brought up here is a very long-standing setup of our favorite setups, which is the asymmetric rewards to risk variety. In short, it squeezes. And this is the USD Korean won. I know it's not the most easily available to be found. For those that can't get it anywhere, particularly in the States, we have IG that you can trade it in Europe. They don't have American clients, but they are maybe on Interactive Brokers you can get it. But we see this currency, and it's a first world nation, the nation of Samsung, which many of us have the devices, the TVs, the fridges, you name it, and of course Kia and Hyundai. We're not talking about the Turkish lira here or the South African rand. A pretty first world nation, in fact, ahead of the curve on the tech adoption and crypto and many other aspects. We see a Korean won collapse. So we see the dollar buying twice as many won, and in fact, with large amount of potential overperformance. You might see back all the way to the Asian crisis. I'm gonna call you a young man by saying you probably won't remember too much about that, Elijah. I'm afraid to say I do. And this particular setup is very much a looky-likey, only on a much smaller scale. And you can see we got a target roughly around there on a massive move on the Korean won. And you can see how skittish, when it's at the extremes, how much overperformance you got with big gaps going in there. So when you're in real stress, this currency doesn't have the depth. Despite being a first world currency. And I'm expecting some Korean-based weakness coincident with some dollar schizophrenic strength. And that's going to lead to a run through the 2,750. And again, with that overperformance, as you saw how much we overperformed last time, it's going to possibly go into major gaps and a little bit of a reset-y type vibe. It's going to feel like the Euro Swiss franc when the peg failed and some events like that. You could have brokers going bust and all sorts of funny events happening if there's a lot in that space being speculated. So there's some bad news for Korea, but this is also a symbol of the dollar potential strength. For those of you who don't have access to trade this particular pairing, I can also highlight the Australian dollar against the USD. There's quite a few, actually, particularly the Commonwealth nations, looking super weak too. People can follow us on Twitter for a share of a chart here. But this is the king. This is literally 100% call on an FX trade that I've made with possibilities to even surpass that. This is a 30-year setup in the making, Elijah. This structure, I mean, I've been following it for nearly a decade, trying to get my hands on it, and it's had a couple of false dawns. This is a key triggering event that fell. This is our trigger here in terms of our methodology. The run of that high is a major triggering event for the commencement in a chronic devaluation. But this is going to be part driven by the dollar strength, and I think there'll be a little bit of extra juice in some Korean-based drama. We've already had a little bit of weird news coming out of there surrounding martial law and various other things. So things a little bit geopolitical could play in your favor. Feels like the oil short call at $67 saying we see single digits. It's got that vibe again.
And can you explain a little bit about why you use the US dollar South Korea currency in particular and why that is a signal for you?
It's 100% technical. It's just the duration. I'm aware that many people will go, well, we don't think the Korean won's a particularly significant nation. Even the yen's more significant. Of course, the euro, the pound, a lot of the Commonwealth nations. But this is driven by how each crisis has responded. You typically get a real loss of a bid when things go badly wrong. In other words, contagion tends to build on itself far more here. The Korean won currency behaves like a crypto when things get really, really hot. That's the problem. And you can see the Asian crisis, how quickly things escalated. You can see 2008, just before 2008, you're at 930. Bang. Next thing you know, you're at 1600. Now, that's not 100%, but it's about 75. So things can get deeply disorderly on the big crisis events. So it seems to have an Achilles heels for major crisis events. And it hasn't had one in a long, long time. And this particular pattern is our favorite pattern. So it's 100% technical that we've chosen that. We're not being awkward by play. But just to illustrate that there will be that dollar strength, I'll pull up, if you have time for it, the Australian dollar against the USD and we'll show you why we think that one is looking so weak. And when you look at it up top here, you can see we have a pattern drawn already. But I'm going to take you off the monthly and maybe just pop it in the weekly. You can see that we've been spilling for a while here in this particular pattern. And this is also Australia missed out on having their subprime moment to a degree because they had the likes of China still buying and creating heat in their economy during that period. So sorry, I'm just battling to get this draw done. In fact, I will take that off and just highlight it here for you. There's a major grind line that's been broken. You had a real capitulation in the CV19 events. And again, we feel, you've got a little bit of weakness. It's not near as pretty for us as the Korean one, but you're already beginning to see this. The Aussie dollar looks compromised. We've got a target well down to 40s, 43 it is. So it's not even 45. So quite a lot of a loss of value. It's about a third on 62, where it is now. And that 62 is after already falling from around 69. So it's already been giving up ground quite a long way. So often your best pairs move early and are already in the spill. So I would argue this is already well on its way. Not for someone who's going to over leverage. It needs to be a long-term setup, but watch that. Sorry for the Australians, but the dollar strength is going to hurt hard them. And we see the similar for Canada, but also not quite as an extreme as it is for Australia. So there might be a little bit of Australian-based weakness. And given that Korea, Australia, that's all in the Eastern Bloc, maybe there's something regional that goes with that. I hope not a geopolitical conflict like a North Korea, South Korea thing. I hope not, China, Taiwan or anything, but we'll find out in due course. I tend not to ask too many questions and trust the charts. But there's some weakness across the board. All of this is actually giving a bid to dollar. So again, those rates coming back to that, that's a headwind for gold and silver. It's a headwind for gold and silver. It's a great time to accumulate cash and to be potentially prepared to buy. So if you were planning of sinking a lump sum now, I suppose what I would be saying, maybe you'll get a better buy opportunity on your gold and silver when this event comes. And you'll get the headline. You'll know it when it's happening. And your dollar in cash, in the meantime, earning you some interest, is actually going to get you more gold ounces a little later. In the long run, that ends. It's a spike. It's a schizophrenic period of dollar strength. Once the debt markets finally stabilizes a lot lower, you're then going to get the actual fiat currency buying power collapsing. So remember the left-right I was explaining in the beginning. And that's when you start to find your goods costing more again. And that's that second surge of inflation. Debt devaluation, inflation. We're having to pay the piper for a lot of sins, Elijah. And it seems that he's coming with his hat and his spear to make sure we stump up real deep this January. And that's why I want to put everyone on alert. A lot of key charts signaling, macro 30-year setups, signaling on the Korean one. Beautiful setup, our favorite. Very tight, volatility ironing out, known for explosive moves. Something's coming there. The gold-silver ratio going the wrong direction, breaking to the upside. The whole bull market of gold and silver will extend a pullback, but that'll mean only more juice when we go up. Then we go back to the yield curve, accelerating right now. That's the moment when the crisis comes typically. Now, that doesn't mean tomorrow. It means during this period, which can be over the course of a month, 6 weeks. It could be 3 months before something happens, maybe even 4. But you're not too far out, something dropping. And I just feel that Trump's going to get a bit of a hot landing. Maybe not on the inauguration day, but not too far out. You'll start to feel the events, and then there'll be some contagion, and we get that super spike in the dollar.
Well, it'll definitely be interesting to continue to track this with you, Francis. We'll definitely want to have you on, probably less than a month from now, just to kind of track how everything is playing out. I hope it's not literal contagion. I know there's some, talk about the bird flu coming and stuff like that. So I guess we'll see how everything plays out, but we really appreciate your insights today and all of your analysis. I think this is very insightful for our viewers. If our viewers are interested in continuing to track this with you, they can go to themarketsniper.com. I know you're also on YouTube and X. Can you tell us a bit about these?
Yes, thank you. As I mentioned, we look for the evidence rather than forming opinions and loving a story. We look for what the chart's probably bringing. to light. And I'm being a bit alarmist today. I'm aware of that. But that is technical patterns that have triggered. We've triggered and crossed lines and levels and that price point. So that's pointing to stress. And that tends to be a very good indicator. It keeps you dispassionate and not too emotionally committed one way or the other. And our sole goal is to help people navigate these reset times to build wealth during this period, not only what you make, but what you keep. And we feel there's a lot you can do in that space. And yeah, thank you for having us on. The YouTube channel is The Market Sniper, and also on X under the same name. And Merry Christmas belatedly, and a safe and prosperous New Year for you all. Just maybe start the year with a bit of an eye on the defense. Defense wins championships. Attack may win a match, but defense wins championships.
Fantastic. Francis, same to you. Merry Christmas, Happy New Year, and God bless.
Bye for now.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for December 30th, 2024 through January 6th, 2025 while supplies last. This week we feature 2024 1-ounce silver eagles at just $4.85 over spot, one of the lowest premiums we've seen in years. We have a limited supply, so these are first come, first serve. Next, 2024 1/10-ounce gold eagles are just $44.99 over melt per coin. We also have an incredible deal on XF $20 gold Liberty coins at just $75 over melt, one of the lowest premiums on pre-33 gold we've seen in a long time. And finally, 1/10-ounce gold Britannia are just $29.99 over melt per coin. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.